Drew Pettit is with us, Director, US Equity Strategy, ETF Analysis and Strategy Research at Citi. Drew, welcome back. Good to have you back on the program. Prashant here. Now we're going into 2nd of April, very fast, very soon. The question really is, are global markets underpricing tariff risks or are they overcompensating for it? What's your sense?
So I think we're underpricing it. Look, it's been confusing for us as well. And honestly, I don't think it's been easy for corporates in America either. So really, yeah, we've pulled back. We've balanced the risk reward a little bit better now than we saw at the beginning of the year. But there's likely earnings downgrades ahead if we get tariffs and if they stay. And honestly, the reason it's so tough is because I'm answering a lot of these questions with if still in the statement.
Drew, hi, great to have you on the program. Given the level of uncertainty, and CNBC did a CFO survey as well, and I think the large majority is actually predicting a recession because of this level of uncertainty. It's interesting because the US market is no longer at least falling off a cliff. We'll get the inflation numbers tonight, but what's your sense? Because the retaliation is also happening. I mean, every day we're getting these new tariffs. Stocks are falling. I mean, auto is showing us that. So what's your sense, first of all, on equities as we enter April?
So to us, honestly, you probably still have uncertainty lingering for the first half of the year. April 2nd likely gives us a little bit more clarity, but it's probably not going to be the end resolution. So to us, whether the end resolution is actually good or bad, it's likely to serve as a clearing event. We'll get more of that on April 2nd, which will help us clear the way to focus on really good fundamental stories, really out the other side. But it's not like it's going to turn a switch on and then just drive a whole bunch of investment right away that's going to have immediate impact. So look, to us, near term, you should still expect uncertainty in the US. Maybe in the back half is when we can start refocusing on the fundamental improvement and the efficiency stories.
All right. Hi, Drew. Good morning and good to see you, Ben. Quick word on the US markets first. I think the S&P 500 you were factoring in maybe in the next 12 months or so, you see 6,100 to 6,500. That holds?
Yeah, I think so. Honestly, a lot of the near-term pain on tariffs, that's coming now. We're starting to feel that the more news we get, the more we can price in. What everyone kind of forgets about on the other side is we have potential tax policy, deregulation, and maybe some more efficient government spend, which should really help bring and keep 10-year yields a little bit lower. Those are actually market positive. So the difference in Trump 2.0 versus Trump 1.0 is we're doing kind of the negatives first and potentially the positive second. So again, no change to our targets. 6,100 is what we're thinking about for full year, for first half, and 6,500 is what we're thinking about for full year.
All right, Drew, what about the Indian markets? You were neutral on the emerging markets because the US economy was in very, very good shape. The flows to the United States as well was very, very strong. A market like India has suddenly started seeing some bit of a pullback with regard to the FI inflows. You've seen a lot of outflows. Your view now on the emerging markets, which you were earlier neutral on, and where does India stand?
So look, still neutral here. Honestly, the one thing that's changed for us is kind of refocusing on where the tariff risks are. While tariff risk is high for China, the market there has gotten a growth injection around AI. So again, China economy heavily exposed, market less so, but we need to keep an eye there for tariff risks and general policy risks. Then next, it's South Korea and Taiwan. Again, heavily kind of trade exposed to the United States. Those are our higher risk emerging markets. India falls a little bit lower down on the spectrum of risk, but we remain really neutral emerging markets here.
And is that the chatter, Drew? I mean, when you speak to your friends and peers and colleagues around the US, is that the general sense that people still don't want to look outside because they feel that the home turf will settle? Maybe it's uncertain for another month, and then it settles. Is that the general feeling?
A little bit. How I would really frame this is they're really just shy around risk assets, whether it's risk assets domestically or abroad. The rotation we've seen has actually not been to buy Europe on its rally or buy emerging markets or spread your equity risk globally. It's been to buy more fixed income. And when you really think about the cross asset view of all of this, if we're going tit for tat on tariffs across the world and there's trade uncertainty, that's where you're going to see flights to treasuries, high quality bonds in general, and even the move we've seen in gold flows in the ETF space as well.
Absolutely. By the way, Drew, did you hear that, see that news? I think it was in Bloomberg yesterday saying that OpenAI is doing a $40 billion round. And they're going to valuing the company some $300 billion it was. I'm not sure. How did that kind of sort of tie into this entire, large mega cap tech rally and, the question of whether a bit of a top is in, etc. What's your sense?
So in general, we're actually still bullish on AI as a theme. So while the stocks have pulled back, the theme, the secular trend, that's still in place. You're not seeing numbers come down for large cap growth stocks yet. Yeah, are there tariff risks? Are there potentially semis risks ahead in semis tariffs? Yes, but if you're looking to improve your businesses, especially if there are headwinds around costs and tariffs, you need to invest in productivity. AI is a productivity tool. So yeah, there's volatility, but we're staying with our calls there. We like AI. We like any productivity trade, even if it's highly volatile near term.
All right, Drew, final question before we let you go. On the European markets, you had a contra bullish call out there, and that's played out well. Is it in the price?
Sorry, apologies, Nigel. Can you ask that again?
The European markets,
Oh,
you had
yeah.
a contra bullish call, and that's played out well. Out of nowhere, we saw the European markets rally. Do you think now that's more or less factored in?
Getting closer there, but look, we're still positive on Europe. And when we look at this from a tariff risk perspective, Europe actually has a lot less than the United States. Depending on how Trump and the administration in the US view VATs and how that plays into reciprocal tariffs, you still likely have less of an EPS downgrade around tariffs in Europe, and it's better priced in than how it's priced in for the United States equity market. So look, the team is still rather bullish on Europe, maybe a little bit less so after the price move, but a little bit less tariff risk there between the earnings setup and the valuation circumstance.
All right, Drew, thank you very much for that. Good speaking with you. It's always a pleasure. And I'll talk to you again soon once we have more clarity post the 2nd of April.